Welcome to Ask Davis. I am Davis, and on this channel we discuss retirement and personal finance in plain language. No jargon, no fluff, just what you actually need to know. Today we are talking about one specific retirement cost that 80% of Americans over 60 have not planned for. And in 2026, it is the single expense most capable of wiping out an entire retirement savings account in a matter of years. Not a market crash. Not a bad investment. A medical need that most people assume someone else will pay for, and that assumption is costing retirees everything. The cost I am referring to is long-term care, not the kind of care you receive during a brief hospital stay or a short-term recovery period. I'm talking about extended ongoing assistance, the kind that becomes necessary when a person can no longer manage basic daily activities on their own. Things like bathing, dressing, eating, transferring from a bed to a chair, or managing a progressive cognitive condition such as Alzheimer's disease or dementia. According to the United States Department of Health and Human Services, approximately 70% of Americans who reach the age of 65 will need some form of long-term care at some point in their lives. That is not a small risk. That is the majority of the population, and yet the vast majority of retirement plans treat this as an afterthought or ignore it entirely. The numbers are not comfortable, but you need to hear them clearly. As of 2026, the national median annual cost of a private room in a nursing home is $108,000. A semi-private room in the same facility runs approximately $94,000 per year. Assisted living facilities, which many people assume are a more affordable solution, average around $60,000 per year nationally, and that figure rises considerably in higher cost of living states such as California, New York, and Massachusetts. Home health aid services, having a licensed professional come to your residence on a regular schedule to assist you, cost between $30,000 and $60,000 annually, depending on how many hours of care you require each week. Now here is what most people do not know, and this is the point that changes everything for someone planning retirement today. Medicare, the federal health insurance program that virtually every American 65 and older depends on, does not cover long-term care in any meaningful or sustained way. Medicare will pay for skilled nursing facility care for up to 100 days, but only after a qualifying inpatient hospital stay of at least 3 consecutive days. Once those 100 days are gone, you are responsible for every dollar of every bill that follows. Medicare does not cover custodial care, the ongoing non-medical assistance with daily living activities that constitutes the overwhelming majority of what long-term care actually involves. Many people carry supplemental Medigap insurance believing it fills the gaps in Medicare coverage. It does not fill this gap. Medigap policies cover co-payments, co-insurance, and deductibles within Medicare's defined benefit structure. And because long-term custodial care falls completely outside that structure, Medigap does nothing to offset it. And Medicaid, while it does cover long-term care, only becomes available after you have spent down nearly all of your personal assets to the program's eligibility threshold, which in most states is $2,000 in countable assets for an individual. You are expected to impoverish yourself before the government steps in. That is not a safety net. That is financial devastation with a federal program waiting at the bottom. Consider what this looks like in practice. A 68-year-old man suffers a stroke. He spends 4 days in the hospital, which satisfies the Medicare qualifying stay requirement, and is then transferred to a skilled nursing facility for rehabilitation. Medicare covers his care fully for the first 20 days. From day 21 through day 100, he pays a daily coinsurance of $194, which amounts to roughly $5,800 per month out of pocket. On day 101, Medicare coverage ends entirely. If he requires ongoing care beyond that point, which many stroke survivors do, every dollar comes from his personal assets. If those assets run out, he must spend down to $2,000 before Medicaid will take over. His wife, still living at home, retains her protected allowance under federal law, but the retirement savings they spent decades building is gone. That is not a hypothetical. That is the scenario playing out in households across this country every single day. I want to pause here for a moment. If you are in your late 50s or early 60s and you are realizing right now that your retirement plan has no provision for this cost, You are not alone, but that does not mean you can afford to leave today without a plan. I put together something called the 90-Day Protocol, Retire at 62 Without Regret. It walks through the exact financial planning steps for situations precisely like this one: healthcare exposure, income gap analysis, and the specific strategies most retirement plans leave completely unaddressed. It is structured so you can act on it immediately, not just read it and set it aside. The link is in the first comment below. Now, let me be specific about what planning for long-term care actually looks like, because most people assume there is nothing practical to be done until they are already facing a diagnosis. That is not true, and the earlier you start, the more options you have. Step 1. Calculate your real long-term care exposure in dollar terms. The average duration of a long-term care need in the United States is 2.5 years. Approximately 20% of people require care for more than 5 years. Using the national median for a nursing home, a 2.5-year stay costs approximately $270,000. A 5-year stay exceeds $540,000. Write that number down next to your current retirement savings balance. That gap between what you have and what care could cost is what you are planning to protect against. Step 2. Evaluate long-term care insurance before your health changes. If you are between 55 and 65 years old, this is the window where coverage is still available at a reasonable cost and where most applicants still qualify medically. Once you are past 65, or once a health event occurs, a diabetes diagnosis, a cardiac event, early cognitive decline, many insurers will decline your application outright, and the ones that do accept you will charge premiums that are significantly higher. Annual premiums for a policy with a $200,000 benefit pool, a 3% annual inflation adjustment, and a 90-day elimination period currently range from $2,500 to $4,500 per year for a 60-year-old, depending on gender, health history, and the insurer. That annual cost is considerably more manageable in your working years than a 6-figure annual care bill in your 70s or 80s. Step 3. Look seriously at hybrid life insurance and long-term care policies. These are permanent life insurance products with a long-term care benefit built directly into the structure. If you need long-term care, the policy pays for it. If you never need long-term care, your beneficiaries receive a death benefit when you pass. You are not paying into a product you might never use, and you are not gambling that you will get sick in order to recover value from your premiums. This approach has grown significantly in popularity because it eliminates the use it or lose it objection that keeps many people from purchasing traditional long-term care insurance in the first place. Step 4. Understand the spousal protection rules under Medicaid before a crisis occurs. If you are married and your spouse enters a nursing home and eventually applies for Medicaid, federal law protects the community spouse, the one remaining at home, from being completely impoverished. As of 2026, the Community Spouse Resource Allowance permits the at-home spouse to retain approximately $154,000 in countable assets, depending on state-specific rules. In addition, the community spouse is typically allowed to keep the family home, one vehicle, and personal property. This does not resolve everything, but it is a critical planning variable that most couples approaching retirement have never heard of, and knowing it in advance, rather than during a crisis when decisions are made under pressure, makes an enormous difference in the outcome. Step 5. If insurance is not the right fit for your situation, consider building a dedicated long-term care reserve within your existing retirement accounts. This means identifying a specific dollar amount based on the exposure calculation you did in Step 1 and treating it as untouchable within your portfolio, not general retirement savings. A separate mental and, ideally, structural allocation designated exclusively for care costs. Some retirees accomplish this through a dedicated brokerage account. Others use a Roth IRA, which has no required minimum distributions and allows tax-free withdrawals, making it well-suited for unpredictable future expenses. The key is that the money exists with a clear purpose attached to it, so that when the need arrives, you're not making financial decisions in the middle of a medical crisis. Here is the bottom line. Long-term care is the retirement cost that 80% of Americans over 60 have not planned for, and in 2026, the financial consequences of that gap are larger than they have ever been. Medicare will not protect you beyond 100 days. Medigap will not cover custodial care. Assuming a family member will handle it informally is not a financial plan. It is a hope. And a hope is not something you can withdraw from when you need it. The only thing that actually protects your retirement savings is taking specific, documented action before the need arrives, pricing insurance options, understanding how Medicaid rules apply to your specific situation, and incorporating long-term care as a real, quantified line item in your retirement income projections. I would like to hear from you. Leave a comment below. Have you already addressed long-term care in your retirement plan, or is this a gap you are only recognizing right now? If this video was useful, please subscribe and leave a like. It helps this channel reach more people who need this information. This is Davis. I will see you in the next one.